All right. Good afternoon, everybody. My name is Elizabeth Rico, and I'm Outreach Manager of Leadership and Business Development here at the Arizona Farm Bureau. I want to thank everyone for joining us. It looks like we still have a handful of people joining on. So thanks for taking time out of your busy day to be a part of this. I'm really excited this month as part of our Webinar Wednesday series for Leadership and Business Development. We have partnered with Inland Private Capital Corporation, and we have Zach Hawley on with us to share some of his infinite wisdom and knowledge about 1031 tax exchanges. So Zach, do you want to give us a little bit of background about yourself?
Sure, yeah, absolutely. Thank you for having me on, and thanks for joining everybody. The purpose of today is just want to educate you a little bit on part of the tax code that most of you probably are aware of, which is it's called the 1031 exchange provision as part of the IRS tax code. But what you might not be aware of is there is a type of 1031 exchange offered by companies like Inland Private Capital that allows you to be a very passive investor and give you the ability to diversify your holdings, turn on income stream, and do a higher quality type property type, and defer taxes from the sale of land or real estate that you may otherwise own. So a little bit of background about me. I've been with Inland now for just over 2 years, but I've been competing against Inland my entire career. 18 years in the commercial real estate business. I was born and raised in Texas. Little story about me. My family owns a feed and tack company, or we used to own a feed and tack company. And I was raised on about 300 acres. We ran cattle while I was growing up. In fact, you can't really tell, but this piece of wood up here on the wall behind me is my family's brand from the barn that we used to have on our property. So I kind of display that. I've got a picture here of me and my father when I was a baby on a horse. And the 1031 tax code is something that I didn't know about until I was a working professional. I didn't really find out about it until I was about 25. Now, the reason that it kind of tugged on my heartstrings because my family, my grandparents eventually needed to turn on income, and they didn't have a lot of money. And when they sold their ranch where we ran cattle, they ended up paying a lot of capital gains taxes on the sale of that ranch. No one had ever told them about the ability to do a 1031 exchange. So part of the reason that I take great pride in what I do is telling landowners, farmers, ranchers, property owners about this unique provision of the tax code, which will allow you to maintain your wealth, turn on income from that wealth, and then ultimately pass it on to your heirs for estate planning purposes. So that's kind of what the talk's about today. Now, how do you want me to kind of construct this?
Sorry, I was on mute out of habit. Let's just go ahead and give a brief overview of kind of who can benefit from 1031 tax exchanges. And the presentation that you had sent me is a really good way, I think, to kick that off. And then we'll go through and anybody can ask questions at any time in the chat feature. And we'll answer those there at the end and see what Zach has to say and what advice he has.
Yeah, great. So I'm going to do a little chat. I'm not going to go. So I do have a slide presentation. I will pull it up on the screen here. I am going to skip around a little bit because this presentation, I could stretch it out as long as I need to. I don't want to keep you here because it's the evening. You all have families. You all have dinner, things to do. So I'm going to hit the high points on the presentation. First and foremost, I'm going to talk a little bit about, and I'm going to share my, can I share my screen? Am I allowed to do that?
I think you should be able to.
It says it's disabled, unfortunately.
Let me go through and see if I can change the settings on here. If not, do you want to email it to me really quickly and I can pull it up?
Yeah, I can do that.
Sorry, guys, bear with us. There's always some sort of a technology glitch.
Let's see here. Okay, should be coming over now. So I'll start off with a little bit about the firm I work for. So I live in the Texas area, but I am responsible for the entire central part of the country, and the central part, it does include Arizona, New Mexico, and Colorado. But Inland itself is a firm we founded in 1968 by 4 Chicago area school teachers. Inland is the 8th largest privately owned commercial real estate investment firm in America. We employ about 3,000 people. Our main headquarters is in the western suburbs of Chicago. Basically, what happened is in the mid 60s, we had these 4 Chicago school teachers who are our founders. They started flipping houses in the suburbs of Chicago before flipping houses really was a nationwide thing. They were investing money for themselves to supplement their income, and they were also investing money for their fellow teachers. And eventually they get so profitable that they were able to resign from their jobs, and they founded Inland in 1968. So ever since then, Inland has been in every facet of commercial real estate over the last 53 years. So we are the market leader in providing 1031 replacement properties structured as DSTs. DST stands for a Delaware Statutory Trust. What that is it's just an investment vehicle that allows someone who sells a property that they own, it allows them to defer the capital gains taxes, put the equity into a property that we would own, and then you would have fractional ownership of that property. We would do all the day-to-day management of that property and all the tax reporting. We distribute income on a monthly basis. And then after a period of years, we sell that property, hopefully at a higher value than we bought it for. And then we allow our investors at that point to decide what they want to do with their equity. If you want to continue to defer your taxes, you could do another 1031 exchange with us or with anyone else or on your own. Or you could just take the receipt of the proceeds and just pay the taxes at that point in time. So 1031s have been around since the 1930s. You may, on the call today, someone on the call may have done a 1031 exchange in the past. A lot of farmers, ranchers, and landowners have done 1031 exchanges over the last couple of decades on their own, because you can do a direct 1031 exchange where basically you sell your property. Let's say you own a property on the outskirts of Phoenix, and a developer comes along to you and says, hey, I want to develop on your land. And you're like, okay, well, I don't want to sell, because if I sell, I'm going to trigger a lot of taxes for me. With the 1031 exchange, what you're able to do is you can sell that piece of land, and you could take the equity from that sale if you follow the rules of a 1031 exchange, which we'll talk about in a second. You can defer that tax and go out and use those proceeds to buy another piece of land, maybe a little bit further out of town. That way you keep your wealth intact for your estate and for your heirs, and you're able to just shift your geographic location by using the 1031 exchange portion of the tax code. So if you'll go ahead and flip a few slides for me. Let's go, keep going here. So I'm going to skip around a little bit. We've been around a long time. All right, so we'll stop here. So we have, like I said, done almost 300 of these sponsored programs. The DST has been a thing since 2004, but like I said, 1031s have been around since the 30s. And we've offered almost $8 billion in equity to investors, but that represents about $16 billion in total property. Inland itself has transacted over $30 billion for investors. over our 53-year history. So we are deeply involved and deeply integrated in the commercial real estate space. Next slide. What you'll see here is we focus a lot today on what we consider to be recession-resistant asset classes. Next slide, Elizabeth, please. Those asset classes that we consider to be a little bit more recession resilient, because let's face it, we've been on a great run in the economy since the 2008-2009 financial crisis. Recession resistant asset classes are living like either student housing, senior assisted living, senior living communities, and apartment complexes. That would be considered multifamily and student housing. We're doing a lot of that today. We're also focused on industrial properties like Amazon distribution centers, UPS, FedEx distribution centers, et cetera. And we're focused a lot today on self-storage because that tends to be very recession resilient as well. Staying away in most cases from office properties because of work from home. For instance, I don't go to an office, I work out of my home. Of course, I cover a large region and I travel a lot. But as a growing trend, obviously. And then retail. We do some types of retail, but by and large, retail has kind of been out of favor with us over the past several years. What I would tell someone, and you can kind of see the returns here on an average annual basis. What I tell people when they're talking about, hey, what kind of return can I get if I decide to sell my property and use one of your properties to exchange into? I typically will tell them that we're going to distribute income to you. Income right now is pretty low historically because property values are relatively high. So we're talking around 3.5% to 4.5% annualized. We do make monthly payments. A lot of that income is tax sheltered. Usually over half of the income is tax sheltered, sometimes up to 100%. So your income that we're paying you is going a little bit further because you're not paying taxes on all of it. But most people, I tell them to just expect income plus whatever the rate of inflation is going to be, because real estate acts as a really nice inflation hedge historically. So if inflation is 5% a year and you're getting 4% in income from us, that might be a 9% annualized return. And we may own and operate these properties for 4, 5, 6, 7 years, and then hopefully give you back more than you started with after we sell the properties. Next slide, please. Here's the example of a 1031 exchange, what it looks like. So on the left-hand side, you see basically you sell a property, we know that you're going to owe taxes on it. So you're left with a pretty big chunk taken out of that property value after paying federal and state taxes. And if you've owned that property for a period of time, maybe you've depreciated that property and you owe even more taxes. But on the right-hand side, what you can see is you sell the property, and then you're able to deploy that full amount of money to work for you for income purposes, and you avoid the day-to-day property management aspect because Inland's going to do that on behalf of the investors. We've kind of talked generally what a 1031 exchange is. When there's one common misconception about like-kind real estate, so that first bullet point there, it says you need to exchange real property for like-kind real estate. That doesn't mean that if you sell some farmland or a ranch that you have to go out and exchange your equity into a ranch. That just means real estate for real estate. So real estate held for investment purposes, exchange for real estate held for investment purposes. So you can go from raw land. You can also exchange mineral rights and royalties. Not a lot of people know that. But you can sell land and you can exchange into an apartment complex or an Amazon distribution center. So like for like just basically means real estate for real estate. Kind of that same thing I just mentioned there. So just real estate for real estate. Now, here are the rules in a 1031 exchange. If you go out tomorrow and you were to list your property for sale and someone buys it with cash and walks up to you and says, hey, here's your check, I want to buy your property. Well, you just disqualified yourself from a 1031 exchange. There is one very important rule that you have to keep in mind if you decide to do a 1031 exchange with property that you own. The first is you need to set up an escrow account with a third party. It's called a qualified intermediary. So most title companies can refer you to a qualified intermediary. Setting up a qualified intermediary costs a couple of $100 generally. And it is one form included in the closing documents when you sell your property. The money has to go and sit at a qualified intermediary because the IRS says that you cannot take constructive receipt of your funds. So if the funds hit your bank account or if you get a check in your hand, you've disqualified your ability to defer taxes using a 1031 exchange. So just be aware that's going to occur. And don't feel like you need to take notes here. I am going to send Elizabeth a brochure that basically has all of this information in it for you. It's like a 4-page brochure. It's a very good general piece that will help you with this. That way you can take a look at that at your leisure. So next slide for me. We just talked about this: seller, qualified intermediary. Then at that point, the money transfers over to the new property. Keep going, please. You do need to be aware there are some timelines involved when you do a 1031 exchange. So you have 45 days to identify your potential replacement properties, or basically what you're going to buy with the dollars that you just sold your real estate for. So the first 45 days is your identification period. Generally, in most cases, people get to identify up to 3 potential properties, and you just need to make sure that that money has been sent from the qualified intermediary to the new property within 180 days. So 45 days is your identification, where you're telling your intermediary, hey, these are the addresses of the properties I'm looking at buying. And then 180 days, you would need to complete your exchange. Some people want to do direct exchanges, meaning I want to go out and sell my piece of land, and I know I'm going to want to go out and buy another piece of land. But having but what happens if you can't complete that exchange? Having backup properties is always important. Inland can be one of those backup properties. And I'll talk about that in just a second here. So next slide. We'll go through this. It'll take too long. Go ahead and skip this one. All right. So a DST. Basically, a DST set up in the state of Delaware. Don't ask me why Delaware. It's just part of the IRS tax code. But it was established in the state of Delaware. Basically, it permits fractional ownership for investors in one piece of property. So if we go out and we buy an Amazon distribution center, for example, we just had one in the distribution center right outside of Tucson is actually owned by Inland. Amazon's our 25-year tenant, and they guarantee the lease. So we own that property there in Arizona. But there are, I believe, in that piece of property, that was a $168 million property. You can imagine in that property, it's owned by 1031 exchangers. I believe in that property, there are somewhere right around 1,200 fractional owners of that property. So we're managing that property. We're communicating with Amazon. We're taking care of anything that has to occur with that property. We're doing the tax reporting. And we're distributing the income to investors on a monthly basis, basically the rent that Amazon's paying us. So those are all considered fractional owners. The goal there would be obviously to do everything on behalf of the trust. And then we ultimately decide when the right time to sell based on the commercial real estate environment. And hopefully we can deliver a nice little profit in a couple of years for our investors. And they have the ability at that point to do whatever they wish with those proceeds. Next slide.
Really quick, Zach, we just had a question come in, and it was something that you kind of just covered. So the question says, can you do a 1031 exchange between family members, for instance, between brothers?
Yeah, absolutely. So if one brother wants to buy a property from another, then yeah, they could be the buyer. You would just need to agree on a price, obviously, and you could send that money to a qualified intermediary, and then at that point seek another property to purchase with those dollars, whether that be a direct purchase you're doing yourself or doing something like a DST through a company like Inland. But absolutely, so that's a real estate transaction. So as long as there's a title company and there's a closing and there's a qualified intermediary in place, then absolutely. So the phases of a DST. So what happens is basically Inland is going to go out and we're going to acquire property. That's phase one. So we're going to acquire the property. We're going to already own it. And then we're going to offer ownership percentages or equity investment in that property itself. So next slide. So we're doing everything on behalf of the investor. We're going out, we're talking to the tenants, we're doing all the demographic studies, all the property location studies, figuring out why it's a potentially good purchase. And then we're going to offer, like I said, equity to invest inside of that. So our programs open and close generally in a few weeks. So if we have a program open right now, it's probably not going to be open in June or July. We may have a different program that's open at that point in time because that one may be fully subscribed or the equity may be fully allocated at that point in time. Next slide. And then we're gonna, once it's fully subscribed, we distribute income on a monthly basis, and then we start operating that property. We act as a property manager. We're dealing with the tenants, the leases. In every one of our deals, we have a forecasted statement of cash flows. So you know what you should expect based on our underwriting and acquisition process, what you would own and what you would cash flow over a 10-year time frame, and also what the anticipated tax sheltering of the income would be for income tax purposes, and what that might result in terms of the tax equivalent yield. So we try to provide as much reporting as possible, and we also take care of tax reporting documents. We issue 1099s, not K1s. So generally that's very convenient for investors because the tax documents come out in January, February. And then we ultimately, based on various market factors, both nationally and locally and with the tenant, we try to figure out when the right time to sell that property to maximize its ultimate profit would be. So lately, as you can imagine, with the real estate market being like it is, we've been taking a tremendous amount of profit on our properties we've owned for 3 to 5 years in the past. So we anticipate a strong real estate market over the next 5 to 7 years as well. So there is some potential upside when we decide to dispose or liquidate that property. And at that point, we give our investors the ability to do another 1031 by sending those funds to a qualified intermediary that you would need to have set up, because we're going to provide our investors with a 60 to a 90-day notice that they're about to get funds back. Or like I said, at that point, they can decide to pay the taxes if they don't want to do another 1031. So next slide. So I'm just going to hit all these at once. The next few slides, Elizabeth, kind of go into each one, so we can just skip those. But basically, the benefits of doing a DST versus a direct exchange. So I mentioned you can do a direct exchange. If you own a rental property, and let's say you own a rental property in Scottsdale and you've owned it for 20 years, and you want to sell that property and decide you want to, you know what, I like being a landlord. I like dealing with tenants and the trash and the toilets and the appliances and the roof and the air conditioners. You know, I'm going to go out and use that equity to buy 2 more rental homes and do a 1031 exchange myself. You can do that on your own. The DST, an ideal client for a DST, is someone that does not want to do the day-to-day management. They're like, you know what? I'm done with the tenants. I'm done dealing with trash and toilets and all these other things I've had to deal with over the last few years or decades potentially. Or let's say I own a lot of land somewhere and I don't need that much land, but I need income. But you don't want to sell the land because you don't want to pay the taxes. Well, a DST through the 1031 exchange is a really nice way to turn on an income stream, not deal with any management responsibilities, get access to property that we consider to be institutional quality or very, very high quality property. Like I said, like an Amazon distribution center or a Class A apartment complex, or a senior housing community right outside of the Mayo Clinic, for instance. We have one right now. Limited personal liability. If there's a loan associated with the DST or any leverage associated with it, that's non-recourse to the investors. So you're not personally responsible for any mortgage or any loan that exists. You have the ability to diversify. So if Inland has, let's say, 4 open properties that you can exchange equity into, you would have the ability, if you wished, to divide up your exchange. So if you have $1 million to exchange and we have 4 investment properties open and those properties are all different, you could drop 25% into each one of the properties to diversify your equity, and not be forced into one particular property. So having a DST option available lets you create your own little real estate portfolio. And then for estate planning purposes, we call it, the crude way to say it in the industry is swap till you drop. So what that basically means is, let's say you sell a property and you never want to pay the taxes on it. You just plan on leaving that money to your heirs. Well, you can continue to do 1031 exchanges throughout your lifetime. And when the will matures, then this client passes away that owns the DST, well, their beneficiaries receive a step up in basis and all the taxes for the estate disappear. So using a DST and 1031 exchanges, great for estate planning purposes. And the insurance policy bullet point there is, like I mentioned earlier, if you decide that you want to do a direct exchange, you want to go from owning land and you want to go try to find another piece of land to buy, but for whatever reason, you can't acquire that new land, you have up to 3 options to identify. So if you can't acquire your first choice and you put an Inland DST program as your second choice, if that first choice falls through, at least you have an insurance policy to fall back on and you're not forced with paying the taxes. You can diversify and put that into an Inland deal, and that would defer the taxes. And we would just operate it for a few years, and then you would have the ability to try again to acquire that piece of land in a few years once the program ends. So you go ahead and skip through.
Really quick, there was a question that just came in that I thought was relative to kind of interrupt you. So the question says, once I do the exchange and it's a rental property, how long do you have to wait until you can move into the property and make it your home? When I move in, is that when you have to pay the taxes?
That would be a question for a CPA. I don't know that I've ever had anyone that, well, I'm sure there's instances that exist where that's happened. But generally people don't move into rental homes. But let's go the other way, because this is the more common thing is, or for what we see is someone has a primary residence. Primary residences are not eligible for 1031 exchange, but if you decide to move out of your primary residence, the IRS generally likes to see 2 years of income or rental income from a property for it to be considered a quote unquote investment property. So if it's less than 2 years, you run the risk of an audit. But from what we've seen in our history, 2 years is kind of the industry standard for classifying or qualifying a piece of property going from a primary residence to an investment property. Any other questions that we can hit?
There's one, but this may come in a couple parts. So let me know if you need me to repeat it. So
yeah, let's go ahead. So the next few slides are going to talk about all these individually. So since I kind of hit them all, let's just kind of roll through the next ones.
Okay, and then I'll ask you the question.
Yeah, keep going.
Right here, or keep going?
Keep going, one more. Oh, there we go. Let's find out how we have more questions.
Okay, perfect. So this question says, I sold a townhouse in Washington State and made a sizable amount in 3 years. The tax accountant told me that I have to pay capital gains taxes. Excuse me. I bought and rolled all of the equity I made into a new house in Arizona. I've always thought that if you roll your equity you made directly into a new home, you don't have to pay the capital gains taxes. The bookkeeper said it had to do with something about deducting parts of the townhome as a home office.
So yeah, so if you've already done that, unfortunately, we can't. There's no 1031 option available. But if you have a rental home, regardless of whether you've deducted out of that home, and it's not your primary residence, when you sell that home, when you list that property for sale, you can set up a qualified intermediary, regardless of how you've deducted expenses. But I mean, if you've lived in that home and you're just using the office for tax purposes, then that might not be eligible for a 1031. But if it's an investment property, then you absolutely, regardless of what you've deducted or carried forward or depreciated, then that's absolutely part of the 1031 code that you could have used.
Okay, and then here's another question. What if the sale or the exchange of the potential property falls through, or it's over the 180-day limit? What happens in that case?
Then the taxes would come due. Then you'd be paying taxes when you file taxes the next year. That's just simply an IRS requirement.
Right, that makes sense. So I have a question. So who doesn't the 1031 tax exchange work for? So if someone's just thinking about it and considering it, what are some markers of somebody who really wouldn't really fit this profile of taking advantage of this?
So in terms of a 1031, now, if we're talking about what we do in terms of a Delaware statutory trust, where the client wants to go passive and be a passive investor and they're just kind of along for the ride, there's really two types of people that shouldn't do a DST. And then maybe the same person, who knows? One is if you want input and control, because Inland acts as the sole decision maker, because we're the advisor to the trust. So we're trying to do what's best for the entire trust, not one particular investor. So you do give up control and property decision making. The other downside of a 1031 through a DST would be liquidity. So there's no liquidity during these programs because you're a fractional owner in a property and your equity is tied up into that property. So we wouldn't be able to sell, 10 solar panels off that property to give you a liquidity, because that would harm the other investors in the program. So that's the major downside to a DST is liquidity. So if you have liquidity needs, the only way that we achieve liquidity is someone needs to buy that interest from you, and we don't act as a broker. So you would have to offer your interest to someone off market through a secondary market, and that would probably be at a discount. So liquidity is the big thing that some people just choose not to do these.
That makes a lot of sense. Here's another really great question, and I was actually kind of wondering this myself. So thank you to whoever answered it or asked it anonymously. They said, if I sell my rental and purchase land that is less than your sale amount, how is the difference handled?
That's treated as, it's called taxable boot. So that's the terminology. So in a 1031 exchange, excuse me, in a 1031 exchange, let's say that you own a piece of property for $500,000 and that's what it's worth when you want to sell it. And your basis in that property, you bought it for $100,000. So you've got $400,000 in gain. Well, your basis is the first thing that exchanges into the new property. So that $100,000 basis goes first into the new property. Anything after that you're not exchanging is taxable. So that's the case we're talking about here. So since basis goes first, capital gain goes second, anything not invested in a new property becomes taxable at whatever rate is applicable.
Perfect. So another question, it says, does it matter how the property is held, partnership or corporation, or does it have to be individuals?
So the selling entity needs to be the buying entity. That is a very good question. So in a 1031 exchange, if you're in a partnership and there's 3 partners and you sell a piece of land in the partnership, that partnership and all 3 partners need to do the 1031 exchange. If one partner does not want to do a 1031 exchange, you need to get with a corporate or a business lawyer, estate planning attorney, something along those lines, and you dissolve the entity and that owns that property and re-register it as whoever's going to sell it, and the exchanging entity needs to match. So that's a very good question. It's one of the things that sometimes can be a hang up. I mean, I recently I had a doctor group. There were 5 doctors that owned a bunch of medical properties, and all of them wanted to sell. 3 of them wanted to exchange, 2 did not, but they were too close to the sale date to get their ownership re-registered. So unfortunately, they were hit with the taxes. So you need to make sure whoever's selling that property, that same entity is going to be buying or exchanging or doing a 1031 exchange of the new property, regardless of whether that's a DST or a direct exchange.
That makes a lot of sense.
That's a great question.
So another question, can an Iowa farm building site, our second home, be exchanged for a second or third home in Arizona? And I think that's a really good question.
Yeah, absolutely. So, I mean, well, assuming you can show some investment purpose, whether that's agriculture or whether that's some sort of income from that property, or but the CPA is going to help you determine that when you're sitting down and talking to them about eligibility for an exchange. But yes, you can exchange property for property, home for home, absolutely.
And then kind of along those lines, so one of the other questions asked if the property that they want to sell is in Mexico, can it be used for 1031 exchange?
Generally not, because the IRS and the 1031 tax code is in the United States. So you'd be dealing with a foreign asset.
That makes sense. With the DST, I believe I heard that you receive monthly payments. If that's correct, are those payments considered capital gains or are they considered regular income?
Ordinary income. Yeah, and the way that it works is so the nice thing about real estate, it's one of the most tax efficient investments out there. So the thing about a DST is, even though you're a fractional owner in a piece of property that, let's say, Inland owns and we manage for you, you're still able to take depreciation and other things against that property. So if let's say we hypothetically send you $4,000 a year in income, well, you may only be liable for taxes on $3,000. Or excuse me, $1,000 of the 4. So $3,000 would be considered tax sheltered. And you would never pay taxes on it as long as you continue to defer through the 1031 exchange. So it's a very tax efficient strategy, even though you're not a direct owner of that property any longer that you're investing in.
Perfect. All right. Well, does anybody have any other questions before we kind of wrap this up? I feel like we've had a really, really good set of interaction here. Oh, okay. Here's one more that just came in. If you've given an option to a buyer, does the time frame start on the exercise of that option?
No, the time frame to exchange only starts upon the close of the sale of the relinquished property. So when you're selling your property, as soon as the closing date occurs and the money is transferred to a qualified intermediary, at that point your clock starts. So there has to be a closing.
That makes sense. Okay. Well, it doesn't look like we have any other questions coming in. Zach, thank you so much. And then for everybody who has joined us, we really appreciate you taking time out of your day to be with us. This will be uploaded onto the Arizona Farm Bureau website under the news section and under the webinar section, along with all of the other webinars that we've done thus far. If you have questions or comments, or you have a topic idea that you'd like to hear, let us know. Reach out to us. We're always excited to hear what you guys have to say and your feedback. And we'll also have the brochure that Zach mentioned, as well as his contact information. And then Zach, you had mentioned too, before we had everybody join us, about your counterpart here in Arizona.
Yeah, so I'm located in Texas. My counterpart and colleague, his name's Brian Lang. He's local to Arizona. So if I'll provide my contact information, and if you have something that comes up and you have a unique situation where you feel like we might be able to help, I could absolutely either handle that myself or hand you off to Brian there locally in Arizona. But we're happy to help. I'm going to send some follow-up information like Elizabeth just mentioned, and then that way we can get you taken care of.
Perfect. And we had one more question come in at the end. Does the purchaser have to agree to the 1031 exchange?
No. The seller is the only one that needs to defer the taxes, right? The purchaser is just buying the property from you. So once the property goes to once the equity from the sale of the property goes to an intermediary, then the person that wants to exchange is the seller. So it has nothing to do with the purchaser. They wouldn't know that you were doing a 1031 exchange unless you just happened to disclose it to them.
That makes sense. Okay, perfect. Well, Zach, thank you so much for your time. We appreciate you coming on with us. And then if you want to look for that up on our website, everyone, it'll be uploaded here within the next day or so. And again, thank you guys for joining us, Zach. I appreciate you. And I definitely learned a lot of things today, and we had a really great conversation. Thank you everyone for your questions.
Yeah, thank you for your time. Take care, everybody.
Of course. Have a great night, everyone.
Bye-bye.